Hello, everybody. Still got a couple hours left in you to see some other investment opportunities. I appreciate the opportunity of being here. It's like coming home. Grew up in the Northwest, as Matt said. A bit about what we do and who we are. Dondo Residential Rental Fund. You guys are probably going, Dondo, what the heck is Dondo? I'll tell you a quick story about that. So a really close friend of mine, a gentleman by the name of Monish Babrai, he's one of the world's greatest kind of value investors. He wrote a book. He's a Warren Buffett junkie, and I've become a Warren Buffett junkie as well in value investing. And Monish wrote this book called The Dondo Investor, and I read it, and it just really resonated with me about how to buy dollars for 60 cents. Finding opportunities where the intrinsic value of the asset is significantly greater than the current market value. And with what we do, and I'll get into that in a bit, it just resonated. And so I'm a great cloner. I said, hey, Monish, can I call my fund Dondo Residential Rental Fund? He said, sure. So that's how we came up with Dondo. My company is called Pintar Investment Company. I founded it about 6 years ago in 2008. We've been focusing on investing in single-family homes for rent as well as for flip. We created these two funds where it's a limited partnership. All the investors invest in the fund. They're owners of the LP on a pro rata basis dependent upon how much your equity is. And then the funds actually themselves buy and own the real estate. And so as an investor, you've got collateral in the real estate directly, which in my opinion as an investor gives you a much greater sense of security because you actually own something, not a note, not a deed, not a lien or anything like that. You actually own a piece of the real estate. Over the past 6 years, we built out this platform and scaled it through property management, technology of analysis and analyzing properties. We've got a very extensive broker network. We've transacted well over 6,000 properties, probably a couple $2 billion worth of transaction volume. In addition to our own funds that we manage, we've partnered with groups like Goldman Sachs, Colony Capital, Progress Residential, KKR Beazer, who've utilized our platform to help them expand and get into their marketplace. And there's been a lot of press about that over the last few years. Our footprint is what we call the Smile States, kind of from the Southwest down through Texas and then up through the southeast of Florida and Georgia. So the 6,000 plus or minus transactions that I talked about, you can kind of see on this bubble map where most of those transactions have occurred. And we've got about a 250-person organization that's out there hunting every day, identifying opportunities for us to acquire, as well as doing the construction and the property management. So through that volume, we've been able to get tremendous efficiencies, tremendous buying power, unit pricing that individual investors might not be able to get on a one-off basis or even a two-off basis. When you're doing the kind of volume that we've done, you're able to negotiate significant discounts and volume pricing across all of the lines, which that savings goes directly to the investors. Some of our fund performance over the last couple of years, we've been averaging since inception about mid-20s annualized returns to the investor after all fees and expenses. If you'd have invested $100,000 with us in the beginning in 2010, that $100,000 would be worth about $200,000 now, so about a 25% annualized compounded rate growth. Our rental fund's up similar percentage, about 22.5%. It started just 2 years ago, and that $100,000 invested back then would be worth about $145,000 right now. I state that because it's interesting. As Matt and the team have probably shared with you guys, when you're making any decision on who you're going to, give your investment dollars to, you want to be able to do your research and understand that investment, not only who you're investing with, but the underlying investment opportunity itself. To me, what I love about this business, investing in single-family homes, even a guy like myself can understand it. Everybody needs a roof over their head. Now, I know a lot of people are talking about hard money loans or tax liens and things of that nature, which are probably fantastic investments. I've got no idea how to get out of those deals, whereas something like investing in single-family homes or the stock market, which is very liquid, It's a huge marketplace. It's a very efficient marketplace, and it's very liquid. Though the comparison to the stock market, as we've witnessed the last couple of weeks, it's extremely volatile in the equities, whereas our performance historically is pretty consistent. These two charts are, for me, as a conservative value investor, the most important thing. That's really kind of all I need to know. The top chart is, over the last 20 years, the rental rate increases in single-family home rentals, and the bottom chart with the red line is the valuation of homes over the last same period. And then you can see kind of the gray lines, those are the recession periods. So on the top, from 2007 and 2009, where we were in the middle of the recession, home values were falling off the face, right? They were dropping significantly, probably decreased 50, 60% in a lot of markets across the country, while the rental rates continue to increase. And so as our investment in a rental house, cash flow dividend is continuing to increase on average about 5% a year, regardless of what's happening in the macroeconomic environment. And so for me as a value investor who's just looking for stabilized cash flow with the potential for upside appreciation, do I believe that the future value of houses are going to be greater than what they are today? Yes. Then I'm comfortable with what's going on in the rest of the world. I'm not worrying about my 401k, that's invested in stocks or mutual funds that's being affected by Ebola or, something in the Ukraine or things completely out of our control. I know people need houses, and if I can professionally manage them, I've got a really good chance of retaining them as tenants and increasing the rents on an annual basis. As an example, this past quarter, we just got done releasing our results, and I'm happy to send it to you. We increased our rents 8% year over year, so it speaks consistently with the Census Bureau here. The other reason why we're so excited about the for-rent strategy is the American dream. Owning a home is no longer today's generation of the American dream. We're seeing a significant shift of households moving more towards a rentership nation as opposed to an ownership nation, and there's a lot of reasons behind that. First and foremost, there's still a lack of availability of credit, and then second, I think people like that flexibility of being able to pick up and move without being tied to some type of a major investment of owning a home. Some of the other kind of overlying demographic trends that point towards this being one of the greatest risk-adjusted investments for those looking for a steady wealth creation and a dividend yield is, historical affordability of pricing right now. The exit strategy to this, some often ask, is how do you get out of it? Well, single-family homes, people still do buy them, right? On average, the average days on market right now is about 54 days across the country. So that's a very efficient market in terms of being able to move out of your house. It's the largest asset class in the world, single-family homes in the United States. And so you've got tremendous pent-up demand with the lack of supply because there's been no new construction, historically speaking. Since post-World War II, we've had an average annual growth of new home builds of about 1.2 million. Over the last 6 or 7 years, we've had less than 600,000. So a growing population of more than 3 million a year, lack of new homes of under 600,000 creates a potential housing shortage, and then you've got a growing demographic shift that's moving more towards renting versus owning, creates a good scenario for upside rental rate increases. So I know it's a lot to absorb in a very quick time, but I might just jump to the good bits on what the fund structure looks like, and again back to some of the key things to consider whenever you're going to be investing with anybody is transparency, alignment of interest, and things of that nature, and how does the sponsor get paid. So in our fund, again, we're great cloners. We follow Warren Buffett's original partnerships. We don't get paid anything until after the investor receives their 8% preferred return. We have an alignment of interest because I'm also an LP. I've got about $5 million of my own dollars inside the fund. All of my partners within the organization, we reinvest all of our profits into the fund alongside the other investors, limited partners. So we're up at night thinking about the same things that you would be as investors. We have a 3-year term on this fund with the intent at the end of that 3 years we will liquidate these assets once they reach their full potential of price appreciation. After the 8% pref to the investors, the profits are split 70% to the investors and then 30% to us as a general partner. And then from a transparency standpoint, we've invested hundreds of thousands of dollars in an investor portal that allows you, the investors, to log in and look at your capital account in detail, as well as that of the fund and each of the individual assets, so you can have 24/7 access to all of the information and all the details of each and individual asset. To the extent, if you want, you can look up and pull up Home Depot receipts. So we've tried to make it as efficient and as easy as possible for investors to participate in this. And with that, my 10 minutes is up, and I appreciate the opportunity to come talk to you.